I'm Chris Wetherbee. I'm the Senior Transportation and Shipping Analyst at Citi. Very happy to be back, and Nicholas invites me to these. I'm always excited to attend, and we're going to be talking about the container shipping market this morning. So I'm joined for now with two panelists here. We have Deambrosio from Seamax Capital Management. He's a managing director there. And then we have Tasos Aslidis from the CFO of Euroseas. So I think we want to kind of cover the landscape of container shipping here. I think that's the idea. And so I'm going to start off with some demand questions, and we'll go through supply. We'll talk about the order book. We'll talk about the rate environment. I also want to talk about the financing environment as well, because it's always very important to how we see these markets evolving over the course of the next couple of years. And we certainly would love to have some audience participation as we get closer to the end of our window here. We're running a little bit behind schedule, but I think we can probably catch us up here a little bit. So thanks everybody for joining us. Thank you, Tasos and Cal. Appreciate it. Maybe I'll just throw out the first question to get us started here, and that's really on the demand side. So as I've been looking, and I cover all of transportation, both sort of surface as well as the marine side, transportation volume has been very solid over the course of 2017. We've seen decent growth, and on the container shipping side internationally, we've seen mid-single digit volume growth. A little bit better on some lanes, a little bit lower on others, but certainly the main lines on the container trade have been very strong. And so, I guess maybe what I'd throw out is, maybe we'll start with you, Tasos. What do you think is driving sort of the mid-single digit volume growth here? How sustainable do you think the demand trends are here? We got an ISM number this morning in the U.S. that was very good. Clearly the economy is doing well, but what do you see sort of backing up these numbers here?
I think, first of all, thank you, Christian. Thanks to Capital Link for the invitation. As far as your question is concerned, I think clearly what drives demand for container ship is economic growth. The fact that for the first time, for quite some time, we had all major developed regions of the world growing with positive trends. Europe, Japan, United States, of course, China is doing a bit better than expected. So all of this synchronized economic recovery and continued recovery has fed into a strong demand for container ship transportation, containerized good transportation, and this is what has driven the demand for our sector so far this year. That to be compared with, for example, 2015, where that number was expected to recover, but really got stuck in the low single digits. So really economic activity, worldwide economic activity is the main driver.
Sure. And Cal, from your perspective, do you see something that's sort of changed as, European strength a little bit more broad-based? The U.S., I feel like we've seen an acceleration too, but I don't know if there's anything sort of specific that jumps out to you that has driven this sort of catalyst in 2017 specifically.
Yeah, Tasos, I think, mentioned it's synchronized recovery overall, because basically if you look at the last few years, container volumes have been relatively strong. Before that, they were pretty weak, and they were weak with the collapse of commodity prices really took out a large part of the world from the trade. Places like Brazil, Africa, Australia, so on, had significant decreases in container volumes. But now with commodity prices stabilizing, even increasing, you see that part of the world coming back on in gear, and Europe as well. For the last 3-4 years, has been really the U.S. has been driving the container ship volume growth, but now we see Europe pitching in, and as I said, the commodity-driven countries as well.
And so when you think about the types of assets that the demand has sort of been strongest for, is it sort of the post-Panamax world with the larger ships catching, a higher percentage of the freight? Where do you see sort of the demand driving? I'm guessing it's on some of those longer haul lines, which probably are a little bit more skewed to the larger vessels, but how do you see that playing out?
Our focus has really been on the post-Panamax sector. We believe that with the opening of the Panama Canal, the requirement, let's say, for a very large asset class, which is the Panamax, the classic Panamax size, would diminish. And so our focus has really been on that side of the market. For the most part, our vessels have been on long-term charters or have been relet on longer-term periods. So we've seen utilization levels in the very high 90s. So for the most part, our fleet is employed. And I think that will continue to be the case going forward.
To answer that from the point of view of what segment could benefit most, because Europe has been the sort of newcomer in this stronger economic growth, and imports to Europe really involve long haul from Far East, where the larger ships get employed, the new big ships. So I would expect the demand growth for that sector would be, in terms of demand, the strongest. Of course, we have to look, I'm sure we're going to look at the supply side later. There's a lot of supply coming up there. But I would imagine that the growth in that long-haul route Far East to Europe, benefiting the larger ships, has been the main one.
And certainly from a ton-mile perspective. So, when I first started covering the space, we ran through a significant sort of uptick in energy prices, and we saw the whole fleet slow down and certainly absorb some capacity. But to your point, Tasos, I guess from a length of haul perspective, ton-mile perspective, as we start to see some of these long mainline trade lanes strengthen, my guess is that sort of absorbs a higher amount of ships than it would if we were sort of seeing some of this more on the feeder side.
That is correct, yeah.
Okay.
I think that's correct.
Helpful. One of the things that we've seen recently, and certainly, would love to have someone from the operator side sort of talking about this, but I'll throw it out to you guys as well, is how do you think about sort of port congestion, port capacity in the U.S. and in Canada? We've begun to hear some concerns about port congestion. We've seen, whether it be from a rail perspective on outbound from the port or just actually in sort of port handling. There's a lot of development and capacity being added, but it's in progress right now. Is port congestion an issue that you guys see at all in your day-to-day business?
We love port congestion from an owner's perspective, so that's something that is always beneficial. But aside from the typhoons that we've seen in Asia recently, that there's quite a bit of congestion right now in China and so on. The Seamen's workers strike in 2015 in the West Coast that basically shut down the ports for several days. The cyber attacks on Maersk this year that shut down Maersk terminals in many parts of the world. We see pretty much tangent growth of both from the fleet side and the port side. There's big questions with the opening of the Panama Canal, whether the East Coast ports would be able to handle and the ports in the Caribbean able to handle that, and that seems to be the case. We have our larger ships now coming to New York, going through the canal, and we do not see port congestion, at least on the main haul trades, as a significant issue to date.
I can concur that. I mean, I'm not in the operations department of our company, but I haven't heard any concerns or issues or reports internally that involve port congestion.
Okay.
I mean, we're also operating in the smaller sector, in the smaller vessel sector that we go to peripheral ports, mainly in Asia, and again, we haven't seen any reports that...
And Cal, from your perspective, when you think about that shift of the Panama Canal, and we just had a representative from New York Economic Development Corporation talking about sort of the port activity around New York and how you think about sort of that split of traffic, how has the East Coast been able to sort of keep up? And, when you think about the port expansion and sort of the market share, particularly in the U.S., as you shift maybe from the west to the east, is there more to do there, or have we seen most of that happen? You mentioned some of the labor issues that we've had here in the U.S. It felt like that maybe was a bit of a catalyst to spur some of that market share shift from west to east. But how do you see that playing out over the next couple of years?
Well, I think that both regions still have their dominant roles to play, and so you're fighting for that middle ground, let's say, between the port authorities. Our view was that the larger ships, the larger companies will drive basically what type of tonnage they like to do in the different trade lanes, and they will always look to achieve the highest economies of scale as they can. So from our perspective, that's what drove our investment strategy to go for the larger vessels, and we're seeing the larger vessels now fully utilized. If you took a look at our fleet a couple of years ago, we had a couple of vessels of the large size calling in the U.S. East Coast. Many couldn't get through the Bayonne Bridge, but now with the expansion of the Bayonne Bridge, that happens. And now we're seeing most of our vessels use the Panama Canal. So there's quite a bit of activity. Now, our vessels can be interchanged. They're really trans-Pacific vessels, or they can be used for the Atlantic trade. But I see that, as long as the port facilities are in line, the natural cargo movements will go to their areas where they're supposed to go.
Sure. Okay. So let's talk a little bit about supply. Tasos, you sort of hinted we're going to go in this direction. I think it makes sense. So, one of the stats that sort of jumps out at me, and it's a number that I try to keep track of here, is idle ship capacity. And, I think in the summer, late summer, we were down into the sort of 2%-ish type range for vessels that are laid up. That's down significantly from earlier in the year, and it's probably the lowest number we've seen in a few years in this space. So, how do you think about that, and what do you think that the direction is there? I'm guessing it's more of a driver of just sort of this economic growth that we've seen that's kind of pulled vessels out. But, is that 2%? Are there really sort of usable assets in that 2%? Can that number go lower?
First of all, you are very right by saying that it has been one of the lowest numbers in the recent years. I think the lowest since 2015 and the second lowest since 2010-11, when it goes below 2. We believe that reflects partly seasonal trends, and in the near term, we would consider it natural for that number to go back up a little bit as the high-end season is approaching its end, and certain requirements would be relaxed. So, and really this is the real number to focus, which relates, of course, to the supply and demand balance, whether the demand growth that we mentioned earlier would persist and will be able to absorb the upcoming supply. So really that's the equilibrium that we need to pay attention to. In the near term, we in the company, at Euroseas, we believe that we will see a little bit more idle fleet in the near term.
Okay.
Primarily for seasonal reasons.
Okay, so just from a seasonal perspective, that certainly makes sense. And how do you think the new alliances, the consolidation in the market maybe affects some of these supply-demand dynamics as we move forward? So that's something that we try to keep track of, and I know there's been some shifts, and we've seen port calls change a little bit, but we saw an earlier presenter saying that it wasn't necessarily limiting the ports that these new alliances were hitting. They, in fact, were kind of going maybe even more places than they had in the past. But how do these sort of new alliances and consolidation within the liner company market change the dynamics here?
Look, I think part of the low idle fleet was the rejiggering of the alliances earlier this year. A lot of these companies took quite a bit of tonnage on just in case they had to do double sailings, and there was some reorganization. So we should see some of that situation correct itself. And to Tasos' point, we're entering the fourth quarter now. That is a slack season for the container shipping industry, so we will see that as well. And there's also the issue that there's about 400 ships that will be delivered during 2017 and 2018, which will add additional capacity. So but back to your question, I mean, from the perspective of alliances, most of these services have now been put in place. Clearly, there is, from the large liner perspective, there is a comparative advantage in controlling your terminals. So there will be a redirection of cargoes to where those liners own those terminals or control those terminals. They're pretty well scattered all over the world and in most locations, so it should have, from a regional perspective, not a significant difference, but from a specific terminal, they may have some differences. But overall, I mean, from our perspective, the consolidation that's taking place, if you think about it, over the last 3 years, the share that the top 5 liner companies will increase. I say will because some of these consolidations haven't been consummated yet, but will go from around 55% to over 70%. So from our perspective, we have a lot less addresses to call on to charter our tonnage. And from their perspective, they have a lot of room to bring some stability to the freight rates, optimize their fleets. I think that one of the hidden reserves, let's say, owners have right now is that the liner companies have significantly optimized their fleet. So any slight deviation from what they planned will probably translate into additional requirements. So you'll see more volatility. I think there's less excess capacity within the fleets of the large liner companies.
Okay.
So that's, if I can add a point.
Please.
Macroeconomically, obviously consolidation is designed to create more efficiencies and which would require fewer ships. So from that point of view, would expect less demand. But that is for a given pattern of trade. If there are changes to that, if there is more demand coming from a region, or if there is congestion in a certain port, these perturbations from the pattern of trade for which you optimized could create spikes in demand for ships due to these newer inefficiencies in the design, which could create the interest, the excitement in shipping. But as a trend, consolidation should result in lower demand for vessels.
For vessels. But from a customer perspective, as vessel owners who charter out their ships to some of these liner companies, as you think about sort of this consolidation, as you mentioned, there's fewer people to call on. How do you think about, do you think there's real sort of legs to rationalization, though, which should ultimately over time be a good thing for the business in terms of the improved sort of credit quality of your customer base, freight rates potentially staying elevated for an extended period of time, maybe being a touch less cyclical than they have in the past. From an asset owner who charters out the vessels, is there a benefit there, or is there maybe that net negative, you think, because of the lack of demand or maybe lower demand for the ships?
In a situation where there is a monopsony, fewer buyers of services, that is good for the people who buy services and bad for the people who sell services. Not exactly a monopoly, but getting close to it. So in that sense, the more consolidated groups are, the fewer clients, the less efficient the market is. They can sort of affect the price more. You can compare this to the dry bulk and tanker markets, where there is so many buyers of capacity, where no one can influence the price. I think on the container ship sector, big companies have the power to influence the rates.
Okay.
Both charter rates and freight rates.
Of course, yeah.
So there's a concern that over time there could be, this further consolidation may be sort of a net negative for the asset owners.
We'll see how, you could say that at the outset. You have to see how the dynamics in the industry will play out.
Sure. Okay.
And how owners how independent owners like us will grow or consolidate on our side. The big companies there's a two-tier market in the containers. The liners who sell services to the exporters, and in turn they buy services from people like us.
Do you think that sort of opens a question that I had here, is that do you think that consolidation on the liner side requires or maybe gets met with consolidation on the owner side, or is that something that's too optimistic for a guy like me to hope for?
I think that happens to some extent as well, more so in the container ship sector than in the dry bulk or tanker sector. There we saw primarily commercial consolidation, which is the one that makes more sense. We haven't seen that as much on the independent container owner side. We'll see how the trends will. We're fighting with the oversupply that we created for the industry for the last 10 years, so we'll see when we absorb that.
Okay. Cal, do you have a view on that in terms of whether you think there needs to be more consolidation? Do we need people who control 100, 150, 200 vessels as opposed to, a number of owners who have a smaller share?
I think there's some of that taking place right now. If you think about the average ship owner in the container ships space, they're larger than many of the other segments. Tasos made a very good point. I think there is some level of commercial consolidation taking place as you start creating pools and things of that nature that are not as broadly used, let's say, in the container ship space. But you're seeing moves to do that. Now it's tricky. Every owner there's an independent streak to them, and it's not always easy, both from an ownership perspective and from a liner perspective as well.
Yeah.
So in history, these consolidations that are taking place in the past, eventually when the market gets better, people start fighting for market share and things all of a sudden change. But I think that we will see consolidation on the owner side as well.
Okay.
It's also, if I may, Christian,
please.
It's also different on the container ship side, because if you become too big, you might consider becoming a liner company too. So, if we're talking about independent owners consolidation, it's a different animal compared to the dry bulk sector. You can be a financial consolidator, like many companies are, especially the ones that are public, but it's a different sort of end point for independent container ownership consolidation.
Okay, that's a good point. I appreciate that. That's helpful. Let's talk a little bit about the order book. So, Cal, you mentioned that the fleet is going to grow. I think you said 400 ships. I mean, we have, a 3.5% target this year, but it certainly is back half weighted, 3.5% capacity growth in the industry, but it certainly is back half weighted because we're running below that through the first sort of, let's call it 8-9 months based on the data that we have of the year. And then we have another 4% growth expected for next year. So it seems like that's a reasonable amount of capacity given demand trends. But how do you think about sort of that rate, that rate outlook or that supply-demand outlook as we move forward? Can we see or expect demand to be able to keep pace and be able to absorb these new ships coming in?
There's a couple of things. If you think about global supply or the fleet over the last 3-4 years has grown by about 25%. It's about 21 million ton TEU right now. And from a ship perspective, it's only grown about 3%. So what you're seeing is very specific growth in the fleet.
Sure.
And the growth is really taking in the post-Panamax, the larger vessels, the 20,000s. And those vessels are basically anything over 14,000 is really dedicated to the Far East Europe trade. So depending on how that trade does, it depends how those vessels will do, because it's difficult to put a 20,000 in the Trans-Pacific or any other trade lane. But I think that it's an ambitious target from a demand perspective to meet. I mean, right now most projections are showing somewhere in the mid-single digits, between 4% and 6%, depending on which econometric firm you look at. So it's going to be, our perspective is that the overcapacity will correct itself a little bit over the next couple of years, but it's not going to be, we're looking more into late 1920 when we start seeing a tighter supply-demand balance.
Okay. Tasos, you're sort of
I think that's
there?
our estimate too. I think we expect to see a sort of a balanced situation with swings either way, depending on how demand shapes out. Definitely the reduced scrapping makes the balancing coming a little later. But if you look at the order book to get a sense of where the industry goes, the order book for the very large ships, it's 100%. Right? As much as the fleet is, the same amount of ships are being built. So there is one concentration there, which would be very much exposed to the Europe Far East trade. And then the other sector that has a little bit high order book compared to all the others is the large feeders, the 2,000 to 3,000, which have an order book of 14%, if I'm not mistaken, for an overall average of 13% for the entire fleet. So if anything, the market forces tell you that these two sectors, the very big ships and the large feeders, could be the months of transport for our industry in the years to come. But there's all the other ships for the time being that we have to work with. And the introduction of the new Panama Canal and the time it will take for the pattern of trade to settle. We'll see whether there will be more cascading and what segments supply will be absorbed faster than others.
Okay, that's helpful. And you mentioned scrapping. That was something I wanted to talk about as well. So as ship owners, and you're thinking about the environment that we're in right now, we've got good demand, but the outlook is still, I guess, a little bit unclear from an owner's perspective. How are you making that economic decision to scrap a ship in this environment? So, when you see what the rates are offered right now, and we can talk about that in a little bit, but, how are you making that decision? Will you expect to see that potentially pick up here or stay roughly about the same?
I think it's not a no-brainer, to say the least, because with the rates having recovered a bit, it barely makes sense to pass a ship through its 4th or 5th special survey. So it's really depends on the specific ship, I would say.
Okay.
This is how we do it. We evaluate the cost we expect to bear if we get it through the survey or not, against the prospects of the market for that particular type of ship. And certain, as I mentioned earlier, because the feeders concentrate on the large feeders, there are some sub-segments of the feeders, we operate on feeders, which we feel that are less commercially attractive, so we might be more inclined to scrap a ship like that if it's to go through its 4th or 5th special survey. But I would say it's more on a ship-by-ship basis at current market conditions. If the market improves a little more, you would definitely go through the surveys and not scrap it. If it goes back to the $5,000 to $6,000 per day range, I think it's a no-brainer that you will scrap a ship that is approaching the latter part of its life.
Cal, does that sound right to you?
Yeah, I think it's as Tasos said, it's a ship-by-ship class situation. It's an owner-by-owner situation as well. I mean, you saw a lot of scrapping taking place a couple years ago, historical high levels. A lot of it was driven by German ship owners or KG owners that didn't really. There's no money there to do the special survey, which will be an expenditure north of $1 million. Let's say if it's the second, third. So I think the same case will go forward. Now, I think every container ship segment, except the very small ones, are they're covering their OPEX and
interest.
And interest. So at that point, I don't think there's going to be a lot of appetite for scrapping, because once you scrap, you give up your option value of some recovery. So I think that, scrapping will be relatively low or lower, let's say, than we've seen the last couple of years.
Okay. So I know you both have different sort of parts of the market where you tend to have focuses, right, on the larger side and then on the smaller side of the market. But, as you take a step back and think about the space, and we've seen that sort of barbell approach in the order book, as you mentioned, Tasos, how do you think about sort of placing bets in this environment? Would there be any reason to sort of vary your approach over the course of the next couple of years as you see this order book develop and you see sort of the alliances connect? I mean, how do we think about that? Is there anything different to do?
We looked at the industry and our investment in it opportunistically, I would say. We have always been trying to find good projects to invest, focusing, as you said, on the smaller vessels where we feel we have better expertise and we can employ them more easily commercially, and also they require less capital to invest.
Sure.
And we were on a smaller company. But we did do a project that was on a larger size. I mean, a few years back, through one of our joint ventures, we bought a post-Panamax container, 5,600 TEU container ship, purely because its price was very low and it looked like a good project. And we have managed to keep that ship just breaking even for the last 3 or 4 years, and now that segment seems to be earning a bit better, and we expect our investment to pay off significantly. So we are, by definition or by choice, let's say, on the smaller size because we feel a little more comfortable, but we would do projects on peripherally larger sizes that we consider good.
Okay. So you're willing to move up the ladder a little bit?
A little bit if the project makes sense.
If it makes sense. And Cal, from your perspective, any change to the way you think about deploying capital?
Well, I mean, I think that the key for us was to be opportunistic and take advantage of relatively low valuations across the segment. One of the things that we did not want to do is tap into the new building market, which a lot of other people does. It's a bit of an easier way to get into shipping, as you don't have to worry about the ship for a couple of years.
Yeah.
Sure.
And you play the option value. So we've stuck to what we believed was going to take over the Panamax segment. As the Panamax segment was the largest container ship space, over 600 ships of these size, that with the opening of the Panama Canal, they wouldn't become redundant, but that particular trade lane would be unavailable for them. It's just not economical. So I think, and back to your point and our discussion earlier, that consolidation, we want to be a significant player in a segment of the market. That gives us ability to have dialogues with the 3 or 4 liner companies that are left, and have capacity and product for them to take. So I think we will continue in more or less the zone that we're in, maybe newer tonnage, but still secondhand in the post-Panamax segment.
Okay. Yeah, that's a fair point. So there's an advantage to being somewhat specialized when you think about your customer base provides you, I guess, maybe with a little bit of sort of heft as well as potential pricing power down the road, I guess. It's a way to think about that.
And ability to fulfill their requirements.
Yeah. Deeper pool. Yeah.
When you have options for them.
Okay. That's helpful. And then this is the question I always love to ask shipping owners, and I'm always curious to kind of see how you guys think about it. But if you were to look out into the crystal ball here for the next couple of years and think about the rate environment, how would you expect it to play out? I mean, it sounds like the comments so far suggest that maybe we're in a little bit of, we're in a better environment than we were before, but not necessarily a great environment yet. I mean, how do you think rates play out over the next couple of years?
I think pretty much as you say, I think we see a more balanced supply and demand. It could vary by segment, but overall we expect, and we're working with the assumption that rates would not go back to $5,000 and $6,000 a day, for at least for the feeder ships, will hover at where we are and gradually improve. I think we saw during the summer and late spring very few inquiries for projects for charters, and despite that, rates stayed around $8,000-9,000 for feeder ships. So that's encouraging. Seems that it means that charters believe that we're moving north from where we are, and they're not trying to. They don't feel that they can squeeze us out. So that's encouraging. We expect to see rates at today's levels or slightly higher.
Slightly higher. Okay. And Cal, from your perspective, does that sound about right?
Yeah, that's about right. I mean, if you think about rates right now in our segments are in the high teens, low 20s.
Okay.
So if you think about it from a replacement perspective, you're in the mid 30s. So there's plenty of room until you start getting people thinking about ordering new ships.
And how do you? So that brings up a great point. And as a analyst, as a financial person, I'm always curious how owners think about that. Do you look at cash-on-cash returns? What's sort of the hurdle level that you sort of need to see to make incremental investments in it when you think about these assets? And what's the term over which you make these decisions?
Well, I mean, we look at it from, we have a 5 to 10 year horizon in our investment. So we're looking to get returns in the teens, 20s.
Okay.
So we're looking to buy distressed assets, operate them efficiently, and get the capital gains from market appreciation. I think that, at least in our segment, I think it's a good buyer's market for the next, let's say, 12 to 18 months. And then I think supply-demand will get tighter then, and it's more of a seller's market from our investment approach, which we're looking to buy distressed-type assets. And
got it.
At that point, we'd probably be looking more at transactions that will be with longer-term charter cover. That gets us into the next.
Okay.
And we've been always had a fixed evaluation framework where we evaluate every project we see in terms of some historical averages, simply to rank it and sort of get within that framework a rate of return. And if that rate of return is above a certain threshold, typically double digits on an unlevered basis, we consider and sort of look into the details of the project.
Okay.
So we try to we try not to use a specific forecast, but a historical framework, like where you are in the cycle. Sure. To start looking at the project. If the technical characteristics are to our liking, we proceed with the investment.
Is there what's the depth of the term market? So are you able to get anything beyond a relatively short-term charter right now? I mean, how available are multi-year deals?
For our segment, I don't think there are that many deals available. Yeah. So we are primarily on short-term charters from 3 months to 1 year.
To 1 year. And Cal, from the same, maybe a little longer on your side?
Yeah, no, we have right now, probably we're in a 3 to 6 month, we're in the fourth quarter. So basically this is not a term. The liners will want term for that. So we've seen some transactions that extend 3 to 4 years. We wouldn't do it at those levels. I think that those are, relatively low charter levels from a historical and from a forecasting perspective. So I think over the next couple of years, we're going to see relatively shorter terms. It's one of the things that attracted us also to this post-Panamax segment, that we believe is going to become more of a shorter-term market.
Okay.
As more of these vessels come off their original charters and start playing the spot market.
Yep. Okay. That makes sense. I have a few more questions I want to touch on the financing side, but certainly want to make sure we have time for the audience. If there are any questions, feel free to raise your hand and jump into the conversation. More than happy to have you. While everybody sort of thinks about what they might want to ask, I'm going to move on to the financing side of it a little bit. For years at these types of events, we talk a lot about the availability of financing or the lack thereof. I don't know, maybe each one of you, if you want to take a shot at what you think sort of the financing market looks like, how much liquidity there is available for ships, or, is there really not much unless you have sort of robust sort of term charters attached to it?
Financing exists and it does not exist at the same time. I mean, we operate ships that are past their middle age, so it's even more challenging. However, we have been able to work with a couple of financiers to get conventional debt, and we're able to finance typically ships in their late teens at a scrap price or 60% of market price, something like that.
Okay.
So, I mean, some deals that we announced last month and took delivery of one of those ships last Friday, we expect to finance them at about 60% of their market
60%.
value.
Okay.
But not many banks do that. I mean, we're working with one or two banks in Greece that still provide elder vessel financing. From international lenders, you can get financing, but even a lower percentage of the market value.
Of the market value. Okay. Does that sound, from your perspective?
Yeah, I mean, I think financing is available for new buildings, with charter backs or longer-term charter type transactions. We haven't had that much issue raising financing for our fleet. Our fleet is, we have charter cover in quite a bit of it, so. But it's definitely a different world. I mean, it's going to like the principal's office now when you go to the bank. It's not a friendly. Let me take you out to dinner and let's try to finance your ships. It's not a robust, let's say, financing environment. It's
more of a pull environment than a push environment these days, is what it feels like. Right, yeah. Okay, that's helpful. And do the leverage levels sound about right? Do you think you can still get sort of 60 if you have, or can you go above 60 if you have new build with term associated with it?
I think it depends on the project. I think, to Tasos' point, I think that you can get 60%, as long as scrap value plays into the equation.
Sure.
That only helps with older vessels. Newer vessels, it's more challenging than to get the 60%. We have an internal cap on the leverage that we use, so we haven't had problems reaching that cap at this stage. Yeah.
Okay, that's helpful. We're running almost short on time here, but I wanted to make sure if there are any questions from the audience, we have a second to get to them. If not, I think we'll probably. Oh, we have one over here.
For Tasos, could you expand on your view on the feeder size, vis-a-vis order book, any cascade concerns?
A lot of cascade has taken place during 2013, 14, and 15. We have to see whether the freeing of the Panamaxes after they become redundant due to the opening of the canal would create incremental cascading. We haven't seen that so far in the market. In feeders, as in all the container ships, people tend to use the maximum economies of scales they can. So that's why all the new orders tend to concentrate on the larger size of feeder. So we don't expect dramatic changes in the dynamics of our sector, as if you compare what we expect to what happened during 2013 and 2015. Great. On your financing point, I think there is more interest for equity financing in the industry lately, right? So that partly
it seems like it
provides.
So we can maybe see a recovery of the equity markets, I guess, from a shipping perspective.
And on the consolidation point, again, perhaps if the industry consolidates, it might have better access to financing. So that, and definitely my company tries to play a role there to act as a consolidating platform.
Sure. The more scale you have, I would imagine sort of the easier the equity piece of the house would be, and maybe we could see a bit of a rebalancing.
Equity, also the debt could be easier if you have a bigger corporate guarantee to offer to a lender.
That's correct, on a portfolio basis. Yeah. Okay. Well, gentlemen, thank you very much for your time. I appreciate you joining us this morning. Thanks, everybody.